Welcome to the Explainer. Okay, let's dive right into this fascinating set of market signals that are, frankly, completely defying history right now. We're looking at a financial landscape today that is just deeply contradictory. And to figure out where we're actually heading, we need to decode exactly what bonds, oil, and gold are telling us. Because right now, the traditional compasses that investors have used for decades to navigate the market are completely broken. Right now, the financial markets can basically be summed up by this brilliant, totally contradictory phrase from market analyst Michael Lebowitz: complacently optimistic. Think about that for a second. We've got major geopolitical risks all over the map, fluctuating energy markets, shifting inflation data, and yet, when you look at the broader market, everything seems remarkably stable on the surface. Investors aren't panicking at all. They're pricing in a scenario where everything just magically works out perfectly.
It's what we call the duck theory of our current economy. Picture a duck gliding across a pond. The market looks incredibly peaceful and smooth on the surface, right? But underneath the water, there is this furious, chaotic paddling going on. The historical rules that have guided markets for decades are literally breaking down underneath that calm exterior.
So if that smooth surface is just an illusion, we've got to look at the actual clues hiding in the data to solve this mystery of what is truly driving the financial system right now. We can't just trust the top-line numbers anymore. We have to interrogate the core assets, bonds, oil, and gold, because their movements, and more importantly, how they relate to one another, are broadcasting a very different reality than what the daily headlines suggest.
All right, let's get into Section 1, the bond and oil anomaly. Let's break this down. For 50 years, the historical rule has been rock solid. Bonds follow inflation expectations. If you knew where inflation was going, you knew exactly where bond yields were going. It was that simple. But today, they've completely hijacked a new steering wheel. Right now, bonds are tracking the price of oil and the associated war premium stemming from global conflicts. The old driver has been completely kicked out of the car. And this perfectly captures the contradiction. Look at these numbers. Real money, people voting with their actual wallets, is betting that 5-year inflation expectations will drop, moving down from 246 to 228. If the old historical rules applied, bond yields should be flat or even lower. But no, bond yields have significantly jumped up, moving from 362 to 430. The market is playing this bizarre game of Dr. Jekyll and Mr. Hyde, telling us not to worry about inflation with one metric while pricing in severe fear with another. And this matters because it completely changes how money flows through the broader economy. Now, to really grasp the impact of this, we have to look at real yields. This is simply the interest rate minus the rate of inflation. Since geopolitical conflicts recently flared up, real yields have shot up almost a full %. That's a massive move. It creates highly restrictive conditions for the economy and acts as a huge weight on growth, completely disconnected from the actual inflation data we just looked at. Here is the crazy part. Traditionally, the correlation between crude oil and bond yields whips around all over the place, often hovering near zero. Today, it has spiked to an over 50% correlation. Right now, if you want to know where bonds or even gold are going when you wake up in the morning, you just have to look at the price of oil. It's basically acting as the market's temporary, overwhelming compass.
Moving on to Section 2, AI's Hoover Dam moment.
We're basically witnessing AI's Hoover Dam moment. Think back to the building of the actual Hoover Dam. It required massive upfront spending, it employed thousands of people, and it boosted GDP in the short term, all for a promised perpetual stream of future energy and productivity. Well, AI is exactly the same right now. Companies have these massive open-ended budgets just throwing cash at building these models, but the economic model for AI in this current state is incredibly warped.
Just look at the reality inside major companies right now. We're seeing businesses wrestling with AI token costs that are doubling roughly every 45 days. Yet when CTOs are asked about the actual productivity improvements hitting their bottom line today, they're only eking out minor gains, around 5%. This raises a huge question. Sure, the upfront spending is keeping the economy afloat right now, but when do the true economic benefits actually materialize to justify these skyrocketing costs? Which brings us to Section 3, decoding credit spreads. Think of credit spreads as your early warning system for liquidity. They represent the extra yield an investor demands to take on the risk of a corporate bond compared to a safe, risk-free U.S. Treasury. They function a lot like a price-to-earnings or PE ratio for stocks. When spreads are wide, investors are terrified. When spreads are tight, they are incredibly confident. Basically, they tell us exactly how scared or comfortable the smart money really is. And right now, the reading is absolutely staggering. Despite literal wars, sticky inflation, and these soaring II costs we just talked about, BBB corporate credit spreads are paying roughly just 1% over treasuries. When you zoom out, that puts them sitting at the absolute bottom 2% of their 20-year historical range. The premium for taking on corporate risk has virtually vanished.
So, the million-dollar question, why is nobody worried? With spreads sitting basically on the floor, the bond market is screaming that liquidity is fantastic and sentiment is sky high. But history tells us that this extreme level of complacency is exactly when we need to be on high alert. We don't need to panic for sure, but this is the precise moment we need to start looking really closely at the foundation of the financial system, like repo rates and money markets, for any hidden cracks.
Okay, Section 4, the cone of uncertainty.
So how on earth do we navigate an environment where all the historical rules are broken? Well, instead of guessing one single rigid price target, we have to adopt a hurricane forecasting framework. Just like a meteorologist tracking a storm, you don't rely on one definitive path. You map out a cone of uncertainty. You build a dynamic playbook for multiple extremes. You mentally prepare a scenario for a peaceful $50 oil glut. And you build a totally separate playbook for a major supply shock driving oil to $150. And then you adjust your position as real-time data actually unfolds.
And within that cone of uncertainty, your assets have to take on very specific, deliberate roles. Take gold, for example. This framework suggests treating physical gold as a multi-generational baseline insurance policy. Think of it as a perpetual savings account against the devaluation of fiat currency that you just keep securely out of sight. On the flip side, paper gold, like ETFs, serves a completely different function. It's a tool used strictly to trade immediate market momentum and interest rate shifts.
Ultimately, the data is showing us a financial system that is betting the house on a peaceful horizon. It's relying heavily on a warped AI spending boom and taking pricing cues from temporary geopolitical oil premiums rather than fundamental inflation. Which leaves us with one really critical, provocative question to ponder. If this market duck is priced for perfect calm, what exactly is going to break first when the illusion finally shatters and the furious paddling stops? Keep your eyes on the data and build your playbooks. Thanks for joining me on this explainer.